we go. Okay. And I'll record that because there are some people that wanted to see this that weren't able to make this meeting this morning, but you'll be the lucky ones and be able to ask questions on this. And I think the way I want to do the questions is I'll show the slide, and then before we move on, we'll just check if there's any questions on it. So what we're going to try to do is we'll talk about the put back ratio trade. And I'm going to get into a little more detail on that, but I'm not going to get into all the detail on that. So there's going to be things like entry rules, exit rules, sizing, all that stuff that is going to be in a different, more of an advanced presentation. So this will be more of a basic presentation. I'm trying to get the trade on, understanding what the risks are on that trade and the advantages. And I'm going to show, what to trade and why. I'm also going to talk about account sizing with Reg T, span, portfolio margin. I'm not sure I even got a slide on that, but we'll see. And then we'll talk about, legging in or buying. I'll just briefly talk about that. And then hedging using futures. And I got a taking profit on there, but I don't think this is how that presentation actually came out. I did get some uh, slides in there on circuit breakers for the market and also for some risk versus buying power and to talk a little about that. So my agenda probably needs updated. And this is the first time that I've given this, of course, because I just finished the slides this week. So it's going to need some changing. Okay. Let's see what we got here. Yeah, okay.
Rick, this is Raghu. I have a question. Are you going to have another advanced session or something later? Or
Yeah, and that's going to take a little longer to put together,
okay,
of course,
sure.
because the details get very complex.
Okay.
Okay, so we're going to explore hedging and then suggest several options for trading and techniques to add free hedges. Let's get into it. Okay, so I'm sure that all of you know what hedging is and what we're trying to do. We're trying to protect our portfolio. Uh, you can't protect your portfolios against small moves down. And I say small moves, I'm talking 3 to 5% even. You can't really protect yourself against that because you can't really buy enough puts or whatever you need to do to try to make money if there's a slight move down. So this is more of it's really kind of focused on a black swan event. And a black swan event, I'm going to define as being something more than um, a bear market even. It may be what causes the bear market, but black swan event usually is something, more than 20% that is unexpected, some market condition in the world or whatever causes the market just to sell off in a dump. And that's kind of a panic selling. That's the best use of the hedging that I'm going to talk about and what we're going to put in here for protection. But while we're waiting for that black swan event, which may not happen, there is a pretty good pullback about every 3 years. But let's see if we can make money while we're waiting on a bigger event and while we have our protection in. Problems with hedging, of course, that it costs money. It's like buying an insurance policy. You buy an insurance policy for your car, for your house, and you don't expect to make that money back, but it's there in case your house burns down or you have a catastrophe that requires you to dip into that insurance. But you're constantly paying for that protection. And most of the hedging that you'll see out there, it's a cost. That's an ongoing cost. And I just don't like to have things eating away at my profits. So that's part of the reason why I like what I'm going to show you here. We don't know whether it's enough protection, and on the advanced class, I'll kind of go into some ways to try to determine how much protection you have and how much coverage, uh, how much of your portfolio is covered or safe. We don't know when the market's going to crash, and um, how much do we really need? You good?
Good. Yep.
All right. So um, historically, the S&P sees 5 to 10% of pullbacks, and so the 5% is about 3 to 4 times a year. And the duration of that drawdown then is from anywhere from weeks to months, a few months. The 10% correction on average, and this is going back, uh, I forgot where it said, but it was back I think in the 30s, that there's about a 10% correction once per year, and taking up to 4 months to recover, and 20% bear markets every 6 to 7 years. And, examples of that are COVID, the financial crisis in 2008, the dot-com bubble that popped in the early 2000s, and 9/11. There's some in 1987, there was a real bad pullback bear market that happened. But those are the bigger ones. And sometimes those take years to recover. So this is kind of the distribution of those pullbacks. And let me get this out of the way. I don't know whether you see that. Okay. So so this 5%, you can see how much more frequent this happens than the 20%. And when I get into the next more advanced presentation on our trade, I'm going to try to take advantage of that 5% pullback and potentially unload some of my black swan hedges, but I want to keep more hedges on there in case we have a 10, 15, 20. So 5% is just kind of a way to make a little money in the meantime, but the ideal is to have something that will protect us for the 10 and 15% drawdowns. Okay, so there's different margin levels for different types of securities. The Reg T is what you'll see for normal equities, and those allow you to buy a little more stock than you have money. So you might be able to buy like twice as many shares of something that's not leveraged in a margin account using Reg T. And I usually call these cash accounts that I'm paying taxes on. They're not an IRA or a Roth. And they're smaller accounts or accounts. I believe they got to be over. I don't know how small they'll allow you to do that, but I think they can be pretty small to be on margin. A lot of people will open an account and won't even open it as a margin account. So the maximum shares that they'll be able to buy are just the amount, based on the money they have. Portfolio margin's a little different. You got to have a larger account. Schwab requires a minimum of $125,000. This is a non-IRA, a tax deferred account. And what TD Ameritrade did in the past, and I don't know whether Schwab's doing the same thing, is if you apply for a portfolio margin account, they give you a options test, and they see if you understand options enough to be able to trade an account with this much leverage. But it's real nice because you can buy SPX and NDX options or sell those options, and there's little margin used compared to the actual fully cash supported trade. Now, span margin is the margin that's used on futures, and most companies will use the standard span margin on it, but there's some companies like apparently Interact Broker that deviates from that. But I believe the span margin rules are kind of like those are the tightest. Now, if they want to make it tighter, um, that's up to them. But this is what Schwab uses. And some of the nice things about that is that if you have a lot of puts, long puts, now I sell a naked put at a different month. Well, my margin required for that naked put in a different month is all based on all my positions, not just that naked put. So I may not require any margin at all to sell that naked put if I have some long puts in a different expiration or even in a different product. So if it's like you're trying to sell puts in SPX or ES, I guess, and you have some in NQ, which is the NASDAQ longs, they'll comprehend that for overall portfolio on when they look at margin. Any questions on this? So this is the back ratio spread. Most of you on this call have already gotten into a back ratio spread. This one right here is using SPY. SPY is a interesting one to use because um, it does provide some pretty good protection for just one back ratio spread. Uh, but it costs $427 if you buy it and you're not legging into it. Now the margin on that, I think that was $500 because we got $5 difference here. And so that's $500 margin because of the difference between these two strikes right here. You actually got a bullish put spread, and that bullish put spread uh, uses the same margin as it normally would if you had one at 610, 605. The second 605 or sorry, the second 605 is doesn't really help you there because you don't have another short up here. All right, so we don't know when that's going to happen. This magenta line decays as time goes on and gradually approaches the cyan line, the line at expiration. Um, I guess I ought to talk about that just briefly in case not everybody's on the same page on the analyzer. But this horizontal gray line right here is your P&L at zero P&L. So when you put on a trade, this pink line, which is the T0 line, or the line that represents the value of that option today, um, that should be at zero when you put it on, or you paid a bad price for it, or got a good deal, one of the two. Let's go back over here to Laser Wand. Anyway, as that's the case, though, this pink line is going to decay and gradually move down and merge with the cyan line at expiration. So it's a negative theta trade because we have more theta being cast off on the long put versus what we're collecting on the short put. It's a positive Vega trade, and Vega is a gamma. Sorry, it's a Greek that represents change in volatility, and since it's positive, if you have a volatility that goes up, this pink line moves up, makes you more money. So the hope is that we get into this trade, sells off, volatility goes up, this pink line goes even higher, and we can make a lot more than even when we put the trade on. Questions?
Is it always 5 points, Rick, in the SPY? Is that desired or any logic why we chose 5 points?
Not a lot of logic. It's kind of where the tested sweet spot was for the SPX. And on SPX, it's 50 points.
Correct.
So
Okay.
when I'm doing it on SPY, I did it for 5 points. There's been a lot of back testing on some of the numbers that I use when I put on these black swan hedges. And I've tried to take everything that I've learned from all the back testing that's been done by me and by many other people.
I see.
And
Okay.
and also I want to say too that Ron Bertelli, am I saying his name right? Ron Bertino, I think his name is,
Okay.
has an excellent course on he's called the space trip trade, but he uses the black swan as a hedge.
Okay.
And it's traded a little differently. And I've kind of taken that and I'm not doing it. I'm doing this black swan hedge without the space trip trade.
I see. Okay. Thank you, Rick.
Okay. So here's what happens. I modified this right here to add a 20% increase in volatility. When the volatility increases by 20%, now you can see this pink line was at zero because that was our $4.43 when we bought it. That's where it would have came out right here on this where these lines cross. And now it's moved up. It's moved up quite a bit. It's about probably about $1,800 of profit, and the price hasn't even moved at all. No decay or anything. That's just because of the change in volatility. If we can take advantage of like a 5% pullback, well, in this case, that's about $3,000 profit. Now, that also means that that pullback occurred on day one because as this pink line decays, the curves are going to be lower, but this volatility is still going to drive all those curves up until it gets close to expiration where it won't matter. All right, so here's a big sell-off. We got, I don't know, that's one standard deviation sell-off right here because we're set right here is one standard deviation. Um, and one standard deviation sell-off will yield you $6,000 just on this one back ratio trade, and you spent $400 on it. So it's I don't know what that is, 25 times your cost. So it's a nice return on that. Questions? All
On
right.
a different note, does this work on upside also, like call ratio spread, call back ratio spread? I mean, we can talk about it later, but I'm just curious.
Talking about doing a back ratio spread on the upside.
Uh-huh.
Um, you can do that, but I suspect that any volatility increase is going to hurt that trade.
Correct. Okay.
Any volatility decrease, I'm sorry, any volatility decrease is going to hurt that trade. And usually volatility goes down as product goes up.
You're
So
right.
your
Okay.
Vega is working against you and your Theta is working against you. And so that's kind of like two strikes against you. And it's tough to make money on a trade like that.
Okay. Understood.
Okay, so here is what do we got here? This is the impact of time decay. Uh, I put the trade on 8/13. And so what I did is I advanced the time that we're looking at this trade to 9/13 by changing this date here. This date's the expiration. This date is the date that we're looking at it. If you come over here and you hit this menu item, you can click reset date and time or reset parameters and all that. And it'll turn your, if you have the volatility setting, like right now it's zero, but if you had it set to 10% or something, and you had this at a different date, it'll reset this date to today, and it will zero out the volatility adjustment. But I've just advanced it 1 month, and you can see how the pink line has decayed. So just holding it a month, um, this was a 60-day back ratio spread. And so we're just halfway through it. And if the price doesn't move at all, we're going to lose most of what our cost is for this trade. But we can still take advantage of a move down. And right now it's not that high, but if we have a move down with an increase in volatility, that pink line will go higher. So it's the last couple weeks to a month, um, these trades are if you can get any money out of them, we may want to be looking at closing them. Questions?
So what is the rule of thumb there, Rick, for closing out when it's not when it has not moved? Like when you lose 50% or when 1 month has gone by? Is there any rule like that? Or
No, I wouldn't use 50% at all because I mean you could be right here and lost 100% right now on paper, but
correct.
then have a
Okay.
sell-off and make all your money. So just because you have 100% loss, that doesn't mean that you need to bail. All
Okay.
right. Now, if you look at this and you look at, I don't know how many people use this option up here. Uh, Normally I set it to +1 expiration, but you can do day step, and so you can increment this decay curve by up to four numbers of days, and you can see how this decays. And when this decay gets down here and gets and you're sitting up here, there's no sense holding it. Just unload it. You're not going to make any money on it, but you probably won't make any money on a sell-off either. So you can look at that. And it's not a hard rule.
Okay.
Sometimes what I've done is I've sold my longs. So I got two longs right here. I sold those longs and then let the short decay because there's little time. Most likely there's little money left in that short, but that's something you can do. This it's sometimes easier just to exit the whole thing if you can.
Okay.
So this is the same time decay. I've got it back on 913. And but what I did is I bumped the volatility up to 20%. And so it looked hopeless right here because we almost had 100% loss. But now, even at this spot, we got about an $800 profit, which is about double what we had to pay for it. And of course, more likely, it's had a price drop. And if it went all the way to a one standard deviation move, we're going to make about $3,500 on that. Now, one of the things I want to talk about on the one standard deviation move is that one standard deviation is 68% of the time. I like to think of one standard deviation as it happens two-thirds of the time. And what that implies is that if I did a trade right here, this standard deviation range means that the price, underlying price of SPY in this case, will be in this grayed out area two-thirds of the time at expiration. All right. There's a probability of a touch right here, and that is twice what the probability is of it expiring outside this gray area. So if this expires two-thirds of the time, it expires outside this gray area one-third of the time, and expires down here one-sixth of the time. But so one-sixth of the time, which is comes out to about 15.86% based on what this says. Okay, so that's the same, that's the percentage of the time that it's going to be out of the money, out of the one standard deviation range. The probability of a touch is typically twice what this number is. So probability of touching this point right here is about 30%, almost one in three chances of one of these back ratio spreads touching this one standard deviation minus one standard deviation line. So, figure 30% chance of being able to take your trade off down here at a profit. And if you're getting $2,000 for that trade, which is where it would be at decay time, full decay time, $2,000 profit for that, you could go four of these trades and you're going to win, one out of three. So you're going to have a winning trade right there. Any questions?
Oh,
Rick, have you looked at using longer term for expiration, like a leap?
I don't use the real long ones that are like a year or so out there because if volatility changes because of a sell-off, that doesn't really impact the leaps because they're so far out there that the assumption is that that leap, everything's going to stabilize by the time those expire. So they're not very sensitive to volatility expansions. What I will do is if I'm looking to add brand new positions and I'm just starting up this trade, what I will tend to do is buy or sell the puts maybe 90 to 120 days out. And because they're not going to be impacted by the volatility. And if I got naked puts out there, I don't want them impacted to the volatility. What I'm hoping is that they will decay and decay enough where I can add the longs to them. And then once I get closer, once I have Black Swan hedges built up in the account, then I don't have as much risk of a naked put out there without any sort of coverage. But once I have enough black swan hedges to actually have hedges, even if I sell naked puts, and it's still my profit curve looks like what I want it, I can sell them closer to expiration. And typically, I don't sell them within 60 days. I try to sell them, over 60 days. Okay, so that's kind of a little more detail that I'm getting into that I don't want to get in. That's going to be more in the advanced class that we're going to do. Okay, so what I want to talk about is which point do I sell that short? I threw a TQQQ in there and just try to compare it, and it didn't work out. So I put that as red because we're not going to use TQQ as a hedge, and it really doesn't work out. But I tried to spend about the same amount of money. So I bought as many contracts as I could to basically use about $13,000 of money. And the cost of um, putting on a SPY hedge at delta of 0.32 was the 671. You can see the numbers there. Took that many hedges or back ratio trades to use up my money. And then my profit at A is a 5% down with a 10% increase in volatility. And you can see the profits on it. They paid off pretty good down there with that little 0.5 delta compared to the 30 delta. But as time goes on, this is 30 days later, the impact that rolls reverse there. The 5 delta becomes a little less, and the ones that are sold a little closer to at the money can return a little more. Questions on this?
So are you saying start with the 5 delta short? Is that the takeaway here?
You can. I'm just saying here's what the impact is. Again, I'm going to get into the specifics on the advanced one.
Oh, okay, sure.
Okay, so again, I said, okay, let's take a look at different instruments to see if there's any impact between them. And I'm doing SPY, SPX, and ES, which is the mini S&P 500. And I say mini, they're about half the size of SPX, and these are 5 times the size of SPY. SPX is 10 times a SPY, in case you didn't know that. And I did the same thing. I took a fixed amount of money and I decided how many back ratio spreads I needed to spend to get that kind of money. And I tried it at different deltas. I looked at my profits with a 5% drop and a 10% volatility increase. And that's what this is right here. And they perform pretty similar between the different instruments. Not much difference. On the B profit, that's 30 days later with a 5% drop in price and an increase of 10% on the volatility. And again, the numbers kind of play out what we looked at on the different deltas is that the smaller deltas kind of become less. And part of that is because as you decay, that 0.05 delta that you put that trade in over decay becomes less and less impactful because you're getting closer to expiration. So think of it as your one standard deviation range shrinks over time. So is the validity of a protection that's that far out. And then I went and compared the cost compared to the profit just to see if there was something significant there. And again, you look at these 20s and the 30s, these numbers are basically identical all through here. So it really doesn't matter which one of these you're using. What will matter is how much margin you're using. The other thing that matters is that your ES is going to have a higher transactional cost than SPX. So buying 20 back ratio spreads compared to 10, you're probably going to be spending, I don't know what it is, I didn't look, but probably about 4 times as much on commissions and fees. So they're more expensive there, and they've got the price of these down pretty good. I think there's Interactive Broker does pretty good, I think, on the fees. I'm not positive on that. Uh, who do we have on Interactive Broker? Dixon, you there? Do you know what the fees are? If you, okay, you got it muted. Maybe he went to bed and recording it. It's bedtime there and where he is.
Yeah, in the chat, he says he needs to check.
Oh, okay. Okay, good. Thanks, Dixon. But it's I think Interactive Broker has some deals on their commissions, and I don't remember whether it was less or more, but whatever. They're it's usually a smaller part of this trade and not that big of a deal. What did I do here? I compared the buying power, and this is the buying power if you don't have any margin on SPY and SPX, but you do have the buying power advantage of the span margin. And so, to buy 100 of these, it's going to cost you $5 million, where you buy 20 of these, it's only going to cost you $213,000 in buying power. Well, again, this is a lot of these trades here. And I think this is, trying to remember whether this is just a straight spread or whether this is actually the back ratio spread. I'll have to look at that again. But the buying power on span margin is nice because it does look at the other positions in your portfolio. So other positions that you have are going to impact the buying power of a new trade. As things decay, then the buying power changes too.
So
All
is
right.
it better to use futures?
If you have a portfolio margin account, I've been told that people like using that. And that's with the Schwab's margining of the SPX. I don't know. Don't have personal experience with that. I was trading a portfolio margin account for several years, and I wasn't doing this trade, but I was just selling naked NDX puts for
Okay.
for many years, and it wasn't requiring a lot of margin until that short put got into trouble. Then it required a lot of margin.
Yes. Okay.
Okay, so based on the instruments we talked about, it takes a lot of risk capital to do the trade, but not really. We'll show you that. Portfolio margin account would allow you to buy SPX with less buying power. The futures is actually uh, the best as far as margin and stuff. And you can use this for large accounts or small accounts. It doesn't really matter. You can get futures margin in a portfolio margin account too. Um, and then all 500 instruments allow for similar protection. And I just wanted to put this here just to show the relative size of the different instruments. Our sample trades that we've been putting on are MES, which is the micro mini S&P 500. And compared to the SPX, it's only 5% of an SPX. So there's 20 of these for every one SPX. There's 2 of these ESs for every SPX, and there's 10 SPYs for that. So just that helps you get an idea of size. And if you start doing a lot of these MESs, then you say, okay, well, I'm going to bump it up to ES. You know that you've just increased your trade size tenfold. Okay, so I want to talk about trading with minimal to no risk, and I don't. Um, and seen this slide for a while. Sorry about that. Okay, so what I did on here is I wanted to try to figure out how much hedging I needed to do. And normally this says, I believe, single symbol, and I changed it to portfolio beta weighted. And I hid all the simulated trades because I wanted to see what my actual positions would do. And I had to uncheck bonds because bonds mess up this curve. I set this to SPX because I wanted it to be relative to SPX, but I tell you the truth, I just do that all the time. I'm not sure exactly what the impact of doing something else up there is. But if I'm right now currently at a profit that is showing me my current profit is $7,000 right there. If we have a 5% move lower, I've set this price slice to minus 5%, I'll be down $2,800. So that's over $11,000 of decrease from this point to here. So I want to cover, well, I guess I got it right here, a $10,000 decrease. I wanted to see what I could do to try to minimize that $10,000. But that's kind of how I can find out what my effective portfolio is going to do over time. I haven't looked at it for Vega or anything else like that, but this is my over time. And this is exactly what it's going to look like if you just have stocks in a portfolio or our TAA trades. Questions?
But if you have option positions, then these numbers may be different, right?
Yeah,
But
you
this
may
is
see the cyan line over here that's even
okay.
lower or whatever.
Okay.
It depends on whether it's a positive or negative theta. But and you may see, bends in this line depending on, if you have a bunch of short puts at 60 100, it's going to go down blue here, then all of a
Okay.
sudden fall off the cliff for the short
Correct. Okay.
puts. So yeah, the options are going to impact that.
Sure. Okay.
Okay, so approximate to 5% drawdown. We got an increase in volatility. Well, that increase in volatility doesn't impact this because I don't have a lot of options that are in trade right now, but it could. So that's how you would find out the impact of that. And what you would see is if you did that, you might see that this number that you lose goes up a lot more.
Okay.
Okay, so now I'm back to a single symbol right here instead of the whole entire portfolio. But I'm looking at a 10% increase in IV. There's got 10% down here. And that jumped my current profit up from zero when I put these trades on because these are all unlocked and floating. It jumped it up right to here, which showing that it's made $11,000 just because of the volatility increase. But you can see how this hedges out. So we were at, I think the one standard deviation, we were about $10,000 loss. And this one standard deviation right here, which I'm not showing down on the price slices, but this is probably about $35,000 profit on that trade. And if we go to 5% down, and 5% down is this point right here, would be up $25,000. So instead of losing money, you can see there's considerable gain in the money. Now, all these are new trades. None of them have decayed, but they're all affecting the outcome. And these trades are all put on with more than 60 days. So more 60 days out there, you still got that protection of a volatility increase. Don't know whether we'll get 10%. That depends on how hard and fast the sell-off is. Questions?
So this 25,000 is from combined multiple back ratios, is it?
Yes, because if we look at the previous slide, it's showing $7,000 P&L on that. Well, we'll take that back. I am not comprehending. I'm just doing single symbols. So I'm just looking at ES is all I'm looking at. How much protection is ES providing? Well, I wanted to have at least 10 at 5%, and I got 25 here. So I could say, well, maybe if I had a 5% volatility adjustment, I'll still get, I won't lose money on that in that case. All
Now,
right.
this is just two trades protecting, is it? Two hedges
I
protecting
don't
that,
know
or
how many are on there.
okay,
Yeah, I don't know.
okay,
Okay, so talk about a no risk entry on black swan trades. If you don't have any back ratio spreads, uh, and you don't want to uh, risk trading naked to start off a trade, you can go in, you could buy the entire back ratio spread. And back ratio spreads are cheaper when you have low volatility and closer to at the money. So not at the money, I'm sorry, closer in DTE. If you buy a back ratio spread that's 180 days out, you're going to spend a lot more money than you're going to spend on buying one that's 60 days out. Um, we're gonna look for 5 to 15 delta for the shorts. During low volatility, uh, the higher delta allows it to be closer to the strike, so that if there is a volatility expansion, those will be more impactful, but the cost is not outrageous at that point. I think we were paying about $70, $65 for one for MES, and that's about $650 if you're buying ES, or about $1,300 if you're going to buy one with SPX. We're going to put the longs 50 points lower, and I don't think anybody's going to be trading SPY, but 5 points lower if you're trading SPY. Questions?
When you say 50 points lower, is that with SPX?
Yes, and ES and MES.
Okay, thanks.
Okay.
is it a 1/2 ratio, Rick?
Uh, we're doing 3x5s,
Okay,
and I'll get into why we do that on the advanced one more.
sure, okay,
Okay, so once you bought two tranches, you'll have a net of 10 longs and 6 shorts. So your net delta between those two are going to be you're going to be a net 4 long puts. Okay. If at that point, if you continue by selling 3 more shorts, well, those 3 shorts are covered by those extra 4 longs that you have on the current 2 tranches. Those won't be sold negative. Those are actually being covered. They may be further away or they may actually be higher. Don't know. But in order to do that, we want to sell those at higher IV. Higher IV because we get more money for our shorts that we're selling. Higher IV because that money that we're getting for them can be further out of the money, uh, making less risk on this trade because we're doing this naked. Think of it as naked. Uh, we don't want those puts to get in the money and have to deal with that. So higher volatility allows us to buy those or sell those puts further out of the money for as much or more premium. So we're looking for that IV increase. So we could look for a couple days down with a pop in VIX, or we can look at VIX going up and then all of a sudden flipping over and starting to head back down. Those are both good indicators to potentially add shorts. If you if you're loaded up with a lot of shorts already and you maybe have too many, but you still want to add more, I wouldn't do it until we saw, and let's say that we have a 5% drawdown, then okay, so now what you're going to do is you may liquidate some of your nearer term hedges and you might sell a bunch of short puts further out in the money, so that you start stacking up your future trades. But you got to make sure that those are far enough out of the money that if you do have a 20% pullback, a bear market, that those aren't going to get into trouble because you're not going to be covered if you're selling more shorts than you have longs. So that's got to be done with caution. What I tend to do is I tend to try to build out multiple expirations, and I tend to use the monthly expirations because it gets too much to manage if I have these trades on every week. So I'll build up, let's say the October monthly expiration, and I'll build out the September week 3 monthly expiration, and maybe even look at December. And right now, I may be starting to look at some of the January positions. I like to sell the short puts at about 2.5 delta or 0.025. And especially at higher IV, that means those things are quite a ways out there. Longs are placed at 50 points below that, of course, and same thing as what we had before. Questions on this?
So this is after the first 2 tranches. This is a rule, is it?
Yeah, the advantage of doing that is that if I bought 2 tranches, I'm going to be long 4 puts
Correct.
that don't have shorts that I'm covering. So if I sell 3 more, these 3 puts that I'm selling naked really won't be naked because I'll have 4 long
Extra
puts that
longs.
are in the trade so far. They do detract from some of the advantages of the Black Swan hedge because those shorts can lose money if it goes down, and the long puts are not going to be making as much money. So, but that as initial guideline, that's a good place to start. As you build up your what I call a factory of Black Swan hedges or back ratio spreads, then when you sell 3, the impact of selling 3 is negligible
Correct. Okay.
because you're going to have so many positive long puts. That's the goal, is to stock up your portfolio with these long puts because they're the ones that are going to grow like crazy with the increase in volatility, and they'll take advantage of the price moving lower. Okay, so if you have no black swan, black racial spreads, and you're willing to sell naked, then what you're going to do is you're going to look for a little longer dated option. And I just put on here just kind of a recommendation about 9 to 120 days. It's not cast in stone, but the longer dated options will give you a strike that's further out of the money than the shorter term options. The higher IV again will get you further away from the money. The shorts, when it's further out in time, will decay slower. So you might have to hold those nakeds longer. But that's part of the advantages of doing it at a higher IV. Same rules on the higher IV. We look for a couple down days with volatility popping up, and if the VIX goes up and then starts coming down, that's also a good indication that the sell-off is over and we're starting to go back in the market and a little safer to get in. Again, looking for the same delta for 90 to 120 days versus 60 to 90 days. That strike's going to be a lot further away from at the money. And we're not putting on longs yet, but they're going to be put on 50 points lower. So after you have your first set of shorts, be cautioned with adding more shorts because you don't want to overload your account and create a lot of risk. So I wouldn't add a second set of shorts until the first one's got covered. And I think all the rest of that's pretty much the same there. So this table that I want to show you is kind of just a summary progressing through the trades. If I sell 3 shorts at first, I'm going to be a net long 3 shorts. If I add the 5 longs, I'm going to be net long 5 or 2 puts. So now I got a complete tranche on. And now if I sell 3 more, I'm only going to be naked 1. And then if I add those longs to this one right here, now I have a net positive 4. So next time I sell 3 nakeds, I'm still effectively have 1 long put and all the rest of them are covered. And then as you add more, you can see how that net longs grows where I'm net long. I got 20 long puts there, more than I have shorts. So you've bought a lot of protection out there and not really paid for it. On the slide note, and I don't know that I can see my slide notes, probably. Is this the slide notes? No, that's not what I want. See all the slides. Never mind. I do have a URL to Ron's training on the spaceship trade, along with his Black Swan hedge trade. If you want to learn a little more about that, does everybody understand this?
Yes.
Okay.
I'd like you to get us to the number 12 so that I don't have any risk.
Yeah. Well, I don't think you have any risk on yours now, as it is,
Okay.
because you bought those. So you're really right at this point right here. You got two of these on, and so you're a net positive 4, I believe, on your positions. So if you have those two MES back ratio spreads, you're a net positive 4 long puts. And then
Cool.
your next move, you can start selling them naked
That's-
if you want. Okay, so I call those no risk entries after you completed the first 2 tranches. It's no risk adding more. Once you completed the 2, you can sell more because they're covered by the longs, which we talked about. And so you don't want to sell those naked. If you want to avoid nakeds, you don't want to sell it to your least net positive of 3 puts. And you can start selling the nakeds closer to at the money. The reason why is because now you're covered. You don't mind as much the risk of volatility increase, but since you still have more puts than shorts, you're still going to make money on the Black Swan hedge. Of course, if you load this up with every short you possibly can, you're not going to make as much money on a pullback. Same rules apply on adding these. Nothing else is different. So our goal right now is to do this with 0 cost on the trade. Normal hedging, you're going to spend money on. This hedging, what we want to do is we want to do it without spending money. Once we have ourselves protected where we can sell those naked, we can put on that risk either initially if you can withstand that risk, or if you have 2 tranches on, you can add the 3 shorts. And what we're going to try to do is we're going to try to add those 3 shorts and then buy the longs for the same amount of money as the credit we took in for the 3 shorts. So in this case, we sold 3 of the November 4700s for 1225, total credit of 3675. And I say points because if you're trading MES, that's not dollars, that's points. On MES, that's 5 times this. On ES, it's 50 times this. On SPX, it's 100 times this, just like any other options, like 100 shares. All right. So again, you'll get the same credit. The total credit is going to be the 3675 points. Now we take that 3675 and we divide it by 5. So what we can do, as soon as we sell these 3 puts, we can immediately put on a good to cancel order to buy 5 of these 4650s, 50 points lower, same expiration, and we're going to offer 7.35. So it will take that 3675 to buy the 5. And that's how much credit we got for this. So in that case, there's no cost to this trade other than the commissions. Does that make sense to everybody?
Yes.
This is quite a powerful thing because once you start building these up and adding them on, if you're adding them on at no cost and it doesn't take any buying power after a while, how many of these could you add to your account? I mean, maybe you're going to get greedy and say, okay, well, if it pulls back 10%, I have a $50,000 account and I'll make $1 million if it pulls back 10%. Uh, where do you stop? I don't know. Gets to be a lot to manage. The other thing too is that if you're going to only sell shorts when the IV spikes, so you're looking for an opportunity of a pullback, um, big up market like we've had, there may not be as many opportunities. So then sometimes you got to take a little more risk in selling those to add to your portfolio. And then I'll go further out in time. All right. So one of the things that you can do in TOS on the chart is put the option symbol in here. So this is the option symbol of a 5,000 put, and I can't tell what that expiration is. I know that it's probably the third week of in 2025, but I can't tell what month it is. 6 month, 1 day. I wonder if that's the DTE. I just never really paid attention to that. Anyway, so this is a chart over time of the price of that option. And when you compare that to VIX, which is this yellow line, it automatically converts the scale to percentage. And I'd rather still see the dollar value on it so I can see how much I'm selling this option for. So in this case, I'm selling that option for 16.75, where in this case, that option was selling for 464. But this is the spike in VIX that drove this contract where those options were selling for so much. So, maybe this is the place to buy. This is the place to, I'm sorry, this is the place to sell. This is the place to sell. This is the place to sell. And you may be selling, so it's going up here. VIX is going up. And if you're waiting for a pullback, well, now the prices are down here. So that could be a difference of, I don't know how to read that. It's 20% maybe. I don't know. 20% less credit that you would get if you waited. If you wait too long, you're not going to get much credit for it. This was that spike a couple weeks ago when that stock IPO'd and everybody went nuts and put money into that. They sold off everything else. So it caused a quick sell-off in the market, caused this to spike up there. But in this case, the volatility started going down even while this price made a high at the end of the day. So there's still opportunity to add shorts right here. Price went down, and here's our week. We had a little spike in volatility. It was very small for this week, and if I created this earlier in the week, it didn't comprehend Wednesday and Thursday.
Rick, how do you put both on the same chart? How do we that?
Okay, so there's an indicator. You go into indicators, and it's called comparison.
Okay.
And so you can put whatever symbol you want in the comparison. You could say SPY, so you can see the relative strength of a stock.
Okay.
But it's handy. I like having that on there because I kind of see what the volatility of VIX does to the price of an underlying stock option.
Okay.
How do I get that symbol? How do I type that in? I do that on the option chain. I right mouse click on that line and I say copy, and it copies that. Then I can paste it over here, or I can send it to red. I'll send it to red, and I got a label here for red, and we'll paste it here. Sometimes that works, sometimes that doesn't. There's been some bugs in this lately. I talked to my friend that works at TD and get that reported.
Okay.
All right. Trading size. let's talk about the trading strategy. Um, we've talked about the proper instrument selection, how much hedging you want to do. You can do incremental protection by adding more trades. Talked about optimal entry. I haven't talked about exit points. I briefly did, like that we want to close some of it on a 5% drawdown and save some for the big juices. But depending on how many we have, we may want to close two at 5%, close one at 10, and save one more for a bigger drawdown. Again, we can look at what's going on in the market. If the VIX is going up, then we might want to hang on to them. And then as soon as the VIX turns around, we may want to unload all of them. So that could be a strategy too. And ignore all this right here. That was supposed to be deleted. Questions? Okay, so I guess I need to delete those slides. I'll put a note in there. I wanted to show just the comparison of the margin required and the price of selling shorts out of the money. And this is, I believe, price transfer. I believe this is for one. Yeah. Okay, so 64 days to expiration, selling the 5,000 short. It costs $750 and it requires $4,300 of margin. If I go all the way out here to February, the price goes all the way up to 40, and the margin doesn't quite double, but it's higher, even though that this strike is further out of the money because there's more risk over time. No, well, actually, this is going to be closer. I'm sorry, the delta on this is going to be a lot higher. So that's probably why the margin is so much higher. If I did equivalent deltas and then looked at it, the buying power or the margin may not be much different. One of the things that, if you look at the price on here, is 40, 30, 23, 16, 7. There's a big difference between the 60 and the 90 or the 100-day. So that drops off like that. So, when you get a chance to start selling shorts, because you're loaded up with long puts and you can sell those shorts naked, you can be selling those. I was going to say for cheaper, but really you're getting less money for them. Maybe that may be the reason right here that you're trying to buy older than 90 days because that's about $375 per month of decay, and this is over $5, maybe $550 of decay per month. So this is kind of a more of an effective mechanism of shorts right here because it's going to decay. The theta is going to decay more over time than the near one. Again, we're at the same strike. Questions? It's kind of just a FYI is all this is. Okay, so I'm going to show a hedge. And I just wanted to say, if we do a 1/2, which is a typical back ratio, versus a 3/5, and I don't remember whether I was going to put a 1/2. Oh, this is the 1/2 right here. We've got half as many shorts as we got longs, and this is a 3/5. So we got one less put. One less put. Go back to what I was thinking on this one here. I'm sorry. So let's look at this. We've got 3 shorts, 6 longs. So the 1/2 model. We collect $9.15 for it. Times 3 would collect 27, or it costs 27. Okay, that's what it is. 27 points to buy it. If we do 3 by 5, you're this one right here, you're actually buying three one by twos because it's a normal back ratio. But this one is kind of a custom back ratio because it's got 3 by 5. So it treats it as one trade. And so that 1775 represents 1 times 1, that's 1775. So that's 10 points less to buy the 3.5. So the 3.5 is about 35% cheaper than the 3.6. So we're not looking for something that is cheaper. That's not the goal on here. What we're looking for is we want to be able to cover ourselves with longs, and we can buy 5 longs sooner than what you would be able to buy 6 longs to cover that same trade. Does that make sense? That's kind of the key point of it, is that if we're only doing 5 here, we can get these 5 covered with these 3 decaying, then these 3 decaying to cover 6, because we're going to have that extra expense of that long put. Any questions on that? It's kind of a key concept of why we do 3.5, though. All right.
Yep.
That typically was my last slide, but I threw some other things in there. Most of you are probably familiar with circuit breakers, and circuit breakers halt trading if there's a certain sell-off in the market. When that happens, volatility is going to spike up. You may not be able to close your positions and take advantage of it, but then they trade, and then they turn the market back on, and they have additional trigger points. And when they turn the market back on, that may be a good opportunity for you to start closing some of these trades down to take some profits. So let's take a look at this here. Circuit breakers for the futures market are a little different than they are for the equity market. And these are more specific to individual future contracts versus the entire market. There is circuit breakers on individual products in the market. So if IBM opened and there weren't any buyers, but they were all sellers, and all of a sudden they had like a 50-point bid or spread risk or something like that prior to opening, they'd probably halt it and try to get those numbers closer before they resume trading. Okay. Dynamic circuit breakers. There's a 2-minute halt if it moves more than 10% within a 60-minute window. So that's more, it's a combination of how far it moves in a certain amount of time. So that's kind of the velocity logic on it, and trying to detect excessive speed of price. And it's a temporary suspension. It's not the end of the world when it happens. In fact, during the first time that President Trump got elected, I was watching the market to see what the impact of the votes would be, and the market didn't expect Trump to win. And when his numbers started to look like he was going to win, all of a sudden the ES sold off real big, real fast, and it tripped the breakers. And so what I did is I immediately submitted a market order to buy it when that resumed, and I got right back in. And right after that circuit breaker ended and the market resumed, that shot up quite a bit, and I made a lot of money on that trade. Probably pretty risky if it kept on falling, but I just didn't think that the market would sell off just because of that. I thought then cooler heads would prevail and market would return to normal. Examples of the circuit breaker in the US. There are 3 different levels. So a 7% decline in the S&P triggers a 15-minute halt, and that's before the normal 325, which is an hour before closing, I guess. A 13% decline for a 15-minute halt. What's the difference on that? I guess if you have the 7 and then it resumes after 15 minutes, if it continues and you get a 13% decline, it halts again. And then the same thing is that 20% decline triggers a halt for the remainder of the trading day. Just kind of interesting to see that. Of course, it's obvious why they're trying to do it. They're trying to just wait for the market to settle down. There was a Black Monday in 1987. I don't know how many of you were trading, but I was actually trading back in 87. And I didn't notice it because I was more of a buy and hold. And I did know that my positions tanked and everybody was talking about it. And I just didn't do anything. And I don't know how long later, but I was already back to where I was. So it didn't seem very impactful to me. But I just remember all the talk about it at that time. Of course, the COVID-19 and the 911 bombing was another time that happened. Max loss versus risk. So sometimes what is my max loss on this trade? Well, is a max loss what your real risk is? And that's kind of what I wanted to show here. The max loss is a theoretical loss. It's not a absolute loss. That would be the max risk. So if you define an option strategy, let's say a short put, and you say, what was my max loss? Well, my max loss is the cost of that put, and let's say that was or the strike of that put. Let's say it's at a 100 strike, then you could lose $10,000 as your max loss. But is that really practical to think that you're going to lose $10,000 on that, or that you'd even be around that long? If you buy a $5 call option for $500, your max loss, of course, is $5 because that can decay to nothing. But if you sell the $50, sell the put at $50, your max loss is potentially very large because it could go to zero. I don't know whether that's the 50 strike or the $50, but whatever. It's still, you can go to zero, but is that real? So the risk is kind of is not the same because most traders will exit or adjust positions before hitting a max loss. So that $5 call option, you may set a stop loss at 250. Then your risk is 250, where your max loss is 500. On a credit spread, you might have a defined max loss 200. Your plan risk could be 100. Again, that's a stop, selling it there. Or because you have a defined risk, because it's a credit spread, your max loss then at that point is the difference between the short and the long. So key difference, max loss is worst case scenario. Risk is about the actual money that you are willing to lose. Nobody wants to lose, but that you're willing to lose based on your trade plan. And max loss, absolute floor. If I sell a naked SPX put at 6,000, I don't want to take a max loss on that, but the max risk may be something I can handle. That's it. Let me show you some things on here. Can you see the screen?
Yes.
Okay, so I have a few positions on. I've added more than what everybody else has done. This doesn't respond too well when I'm on a Zoom session, but these are my current positions I have on MES, and I started selling some before I started doing the Black Swan hedges just to create some revenue. And I really have only the two Black Swan hedge trades here. So if we take, let's just take one. Let's look at it on the risk profile. And we can see, are we on today's expiration? Yeah, 10/18 is expiration. So 10/18, I can lose $75 total. If we get a 10% pullback today, I can still make $267, which is not bad for a $75 investment. I have a different expiration on this. No, these are both October. Okay. So I can really look at these together, and I can see I got $142 of my money into this trade. 10% down, I can make $600. It's not a lot. It's not going to make me rich, and it's not going to really protect my portfolio. So let's go back. There's another easier way to select this too. You can go here and you can select different expirations. So this is my November positions. And you can see that at expiration, that's where it's going to be. So this, you know that this pink line is moving up to meet that blue line. So down below here, I'm making money on theta decay. Up here, I'm making money on theta decay. And right here, I'm not doing anything on theta decay because it's right on the expiration line. But as the price moves down, now look at my protection on it. My protection, watch this table as I move my cursor. My protection is only going to give me $237, and I don't know how close that was. That may be close to what these are right here too. But I can also look at this right here. We're looking at minus 10%. I can look at P&L open, that's $238. So that's the same. I've moved this yellow price slice from the -1 standard deviation over to this just to see what it looked like. Now, I know that I have some trades on, so I can go back and say, come on. I could say, what is the impact of me filling this trade or filling this trade? So what I've done is I've added two simulated trades to my November position, and that's what my curve looks like once I fill those two positions right there. And if it goes down that 10% now, my P&L will be $1,200. That's not bad for maximum risk of $260, getting $1,200 back on a 10% drawdown. 5% is still, almost double my money. But that's the impact of that. And the other thing I want to show here real quick is I'm offering $7 for it because that's what 1/5 of the credit that I received for the longs. And it's only $1.50 away. Yesterday morning, it was $2.50 away. And because we went up yesterday and the volatility went down, that it got closer to me filling those particular options. I can also look at the VIX. And you can see the drop in volatility on the VIX yesterday. We've hit new record lows right now. So, we can be buying these back ratio spreads for as cheap as we can get them for. If the volatility gets back up to here, I don't know what percentage it is, 14 to 16. It's not a big percentage. Let's say 2 over 14. That's 14%. We go back to here and I look at MES again and I modify the volatility. I say 14%. Then now my 10% drawdown here becomes $2,700. So and even if the price doesn't move, which it would if it's sold off, it's still over $1,000 today. My ES positions, I have a few of those on, a couple fully formed Black Swan hedges on those at the 5% level, making $462. Look at my cost on this. My cost is I've gotten $468 in credit. That's because I sold uh, the short put here. I actually sold one some time ago, and I added the additional two and then the 5 longs. But I sold that for like $22, I think, one of them. So, my total money on that is like for about 400 points, 4,400 points, 40 points. And you divide that by the 5 would have been, I could pay up to $10 for those, or 10 points for those and still get those for cost free. I look at my other options. I got another fully formed in October. And I'm trying to, that's October is 55 days out. So I'm not going to sell any more shorts on that one because it's less than 60. So I'll just let those two ride. But on the combination of the two, what it does to the curve, you can see that's the $7,000 here or $3,000 there. We go to what else I have left over. I sold 3 for 11.75, and I'm trying to buy these long puts here in November. That may be the only thing I have in November. In December, I got 2 nakeds, 3 nakeds, 4, 5, 6 naked puts in December. And once I buy back the 5 here, that will be covered. I buy the 5 here, those will be covered. And I'll show you what that looks like. We go from here, analyze trade, right to here, analyze trade. Now, when we look at that, I'm including the ones that I'm hoping to fill at those prices. Now I got some substantial protection there. So 10% down is about a $9,000 profit. 5% down is $100, $4,600 profit. And let's bump the volatility again. And I'm just going to do 10%. Now that 5% is a $14,000, and that's $22,000. And if we looked at my portfolio earlier, and I don't remember where that was from my portfolio, I said I needed $9,000 protected at the 1 standard deviation point. Well, here's the 1 standard deviation point of that expiration. Well, let's do this. Portfolio beta weighted. This may take a minute. SPX. Let's go hide positions. And I'm going to uncheck all my positions because I want to uncheck everything really. Right. I'm show all. Okay, I'm sorry. I'm going to hide simulations. Check them all in. And so this is my actual positions. And a 1 standard deviation move, let's say, and this is based on a time frame. So let's do it in 2 months. October 18th. And we're going from $88,000 profit, current profit, to $26,000 profit. So I'm going to lose about $60,000 if we have a 1 standard deviation move down. Now let's show all. And I got the simulated rates unchecked, so they won't impact anything on here. I'll go down to the, I got a lot of trades here. Probably should have cleaned that up here just to make it a little easier. Anyway, let's get down to the ES. Where is ES? Oh, here it is. Sorry. We'll check these back in. And looking at the impact of that move down. what did I say was the impact before that? Oh, I guess we were looking at a particular expiration, but that's about $60,000. Oh, I gotta uncheck this without this. Okay, so my impact is $60,000, going from 93 to 34 with ES. I'm about $50,000. So I don't have a lot of protection here. Only about $10,000 protection or $10,000 protection. So I'm gonna be adding more so that if it comes down to here, I want to get this about 50%. So I mean this doesn't change too much right here, but this point right here that get it down here. I'd like to get it where it's up this high. And you can see that, well, the scale changed. Sorry. Let's do this. Fix the scale. Now add it. So you can see how it pulled that up and also, lowered my risk further out. But that's kind of a way that we'll use to determine our scaling and how much protection we have. But and it also shows you that we want to build a bunch of these on here. We don't want to just have a few. Any more questions on this?
I think it requires more practice to figure out.
It's going to take a lot of
Average.
practice, and we'll learn as we go on. I mean, the nice thing about this is if we go back to let's go back to MES. We go back to this, unlock. We know that we're putting on protection. We just don't know how much we got yet.
Correct. Okay.
Rick, do you have a spreadsheet where you keep track of what goes with what? Because that's a lot to track.
Something like this.
Yep, there you go.
Yeah, if you're trading on toss, this will work. If you're trading on Interactive Broker, you can do it, but I don't know how to do it, and I don't really want to try to figure it out.
Yeah.
But I just put the option symbol here, and then it fills in the description, the expiration date, and the days to expiration. So I put this one on at 49 days expiration, and there's 28 days left. Actually, this is, I think, yeah, that's the D4. D4 is that. Okay, so that's figuring out how far it is from that expiration. I thought this was calculating it too. Oh, yeah, it's getting the days from this right here. So it gets the expiration date, then figures out the number of days till expiration. D4,
Yeah.
D4, A4. Oh, I must be looking at, I don't remember. I think that was, I put it on 49 days expiration and there's 28 days left. Here's my quantity. Here's my credits. This is based on the current price, the mark, probably. Where am I getting that price from? G5, F5. I did this about a year ago when I was working on this, using the quantity. Anyway, this is the current price. And then if it's negative, it's a profit. If it's positive, it's a loss. And this just means that I bought my puts for more than what I sold my calls for. I'm sorry, my shorts for. And I stepped into this one too. So I had this naked put on before I started doing the Black Swan hedges this time. And I got a few more things to add on here. And I also had one that I started for the micro minis.
Yeah. Did you share that with us?
I could. I'll go ahead and delete some of the stuff on here because you don't need everything that's on the spreadsheet.
Yeah. Thanks.
Okay. Yeah, I'll share those two. All right, I think that's all I have for today. So unless there's more questions, I think I'll shut her down.
Are you going to share the recording or something, or later?
Yeah, I'll get a recording of this and I'll see if I can post that on. I'll make it available.
Sure.
All
Thank you,
right.
Rick. Really helpful. It clarified a few more doubts I had. I think